welcome again to the show, Crucial Investment Conversations. And I really want to talk about putting, our pullbacks in perspective and how bond funds might be the right answer for you. So, if you think about earlier this year, or I should say last year, right? We had COVID-19. A lot of businesses throughout the country shut down, created a big drop in the stock market, about a 20% dip, and then within a rather short period of time, the market recovered, right? And it's been growing. And if you've been following the S&P 500, it's been doing exceptionally well. But I do want to point out something is that most of the growth that you see in the S&P 500 is only coming from, I'm going to say, probably the top 5 or 10 companies in the S&P 500. So really and truly, only 5 or 10 companies are influencing the whole index, right? So that kind of leaves some, I guess you can say, some curiosity as well, what's going on? So we're going to talk about that today. So the first thing I want to say is that, pullbacks in the market, that actually really is healthy for our economy. And the second thing is that it does create opportunities for investors. And so it really depends on, having your money positioned in the right place at the right time. So let's go ahead and move on. And if anybody, if something is going wrong with this webinar, maybe you can't see something, can't hear me, please shoot something in the Q&A, and that way I can, make that change relatively quick. And so, again, looking at the investment outlook for 2021, what do you want to do? The dynamics for the economies in the market, where do you want to place your money? With the recent political craziness that's going on, how's that affecting the market? And so where do you put your money to get, your piece of the pie is really what we're talking about. And so I just want to take a quick second to tell you a little bit about my history. Way back in 2008, I was in the corporate world. At that time, I was in my early 40s. And I thought I was doing really good. I was on pace for retirement. Everything was looking great. And at the end of 2008, the stock market took a huge crash, really devastated my portfolio. I'm going to say nationwide, the average was about a 38% loss. Mine was about double that. I was in some really aggressive portfolios. It really wiped me out. It was at that time I started thinking to myself, man, you really need to learn about investing. You really need to learn about retirement. And so I started studying, I started learning, I started doing my research. I liked it so much that 2 years later in 2010, I made a career change. And that's when I jumped into the financial industry. Since then, in the past years, I've really, put together, I'm going to say, a process, if you will, that what I like to say is I like to say I developed and refined this process to put all the pieces of the puzzle together to create the ultimate wealth system. And I call it the 3D wealth system. And so if you were to meet with me, you become one of my clients, I'll take you through this 3D wealth system process. And then we will customize and make a special financial plan specific to you and your goals, your objectives, and your risk tolerance. And that's what I want to talk about today a little bit before I show you some solutions here, is risk tolerance. And so if you take a look on the lower, risk level, which is over to the left, a conservative investor is somebody that's looking to protect their principal or their capital. That's their goal. They want to protect it. And even if that means losing out on higher gains. Typically, I'm going to say this is the individual that's already been saving for years. Maybe they're already in retirement or they're approaching retirement. And their real goal is not to lose the money. They want to preserve it. They want to preserve their capital. They don't want to just stick it in the bank and not let it grow at all. They want to get some kind of growth, but their primary objective, again, is to preserve that capital. And even if that's at risk of losing higher returns. We're going to talk about that conservative person today. And then the moderately conservative is, again, their primary goal is to preserve their principal, but maybe they're willing to accept a little bit of risk, and that way they can have a small degree of return. So we're going to focus on these two categories today, and I'm going to show you a solution, if you fit within that category. Now, in previous weeks, we've talked about different investment portfolio managers. Today, we're going to talk about Guggenheim Investments. They have been around since 2001. Guggenheim is one of the leaders in the financial world. If you take a look at this, they manage over $205 billion in assets, and that's a B for billion. So that's how much assets they have under management. They have a very large investment team, and they are a global company. However, they're primarily, here in the U.S., and you can see some of those cities that they're based out of. But I want to point out a couple of things, and that's where they have their money invested. So for people that want to preserve their assets, maybe you want to preserve your assets, or maybe you're just a conservative investor and you want some growth, but you really don't want to take on a lot of risk. Well, Guggenheim is really that type of portfolio manager. You can see here that 70% of their portfolio, that's in fixed income. Fixed income is really bonds. And so what we're talking about here are corporate bonds. Typically, most of these bonds are even secured bonds as well. And you take a look at this, they got a very small percentage going into some of the other asset classes. This is what I really find interesting about Guggenheim, is that I'm going to say over 80% of their money is in institutional funds. And I'm going to define that for you. So if you can see, this is their largest category. 65% is by insurance companies investing with them. The other 17% comes from other institutional corporations or foundations, such as maybe a pension fund, or it could be an endowment fund, such as the Harvard Endowment Fund from Harvard Business School and Harvard College. And then they have a small segment, you can see here, 18% is for what they call retail. That would be the individual consumer, fits in there. So I want to talk about this in insurance and the institutional class. The way that works is, many insurance companies, they have millions and billions of dollars. And when they invest, they're looking for secure, they're looking for very low risk, and they want to have a nice, decent return. And so if I put this like in, let's say, a baseball analogy, insurance companies, they're looking for singles, right? They're not looking to hit a double or triple. They're not even looking for a home run. They just want a single hit. And that's what Guggenheim does, is it basically, it is designed for singles. Occasionally they might hit a double, but that's not their goal. That's not their objective. Their objective is very low risk and getting those singles out. And so an insurance company can come to Guggenheim and they might say, I want to invest $5 billion and I'm looking for a portfolio to give us X amount of return. And we want to, have it for X amount of years. That's what Guggenheim does. That's their specialty. What's really cool about that is that they create these funds for these institutions, and they open up a small sliver for the retail consumer that we can basically hop on that bandwagon. So that's really cool. So anyway, let's go ahead and move on. Guggenheim has won many awards in the industry based on how well their portfolios have performed. And the best thing I can say is they do have a variety of products or solutions. Really, that is based on the risk tolerance of the individual. So they have different risk classes, but they've won many awards. And then I just want to kind of like maybe dig down a little bit here. So this is the Guggenheim Total Return Bond Fund. And I don't see any questions, so I just wanted to check and make sure everybody's with me. So it looks like I'm doing well. So this particular fund, okay, this started back November 30th, 2011. As of 6/30/2020, they had $18 billion in this fund. Okay, so that's how much money this particular fund is managing. This is definitely for that conservative or moderately conservative investor. Okay, something that I'm just going to try to make really simple, not make it too complicated, but this is what we call the Sharpe ratio. And what the Sharpe ratio is basically it measures what the return of the investment is based on the risk that you take. Okay, and that's the best way I can explain it. And so it measures not just what the return is, but based on the amount of risk that you're taking. Okay, and I can tell you in the investment industry, a Sharpe ratio of 1.0 or better is considered good. Okay, and a Sharpe ratio of 2.0 is excellent. 2.0 is kind of like unheard of. You don't really see that very often. And you can see that their Sharpe ratio is 1.84. So that just shows you how good they are. Now, if you look at this gray box over here, okay, this is their what they call their benchmark, okay, which is the Bloomberg Barclays U.S. Aggregate Bond Index, okay. So if you were to invest in this index, it would give you a Sharpe ratio of 0.96, which is relatively good, okay. Let's just move on. So I just want to kind of show you, some of the returns and see what they look like. So let's start here. Year to date, you can see that even with this COVID environment, this is Guggenheim in purple. They've had an 8.96% return. And then if you look in the gray, this is their benchmark. Okay, oops. That's their benchmark, and that's who they're measured against as far as like, if you want to be a good portfolio manager, you should always beat your benchmark. So you can see that they're doing that. This next blue column right here, this represents all of the bond funds that are in that same class, right? And just averages it out. So this is an average of everybody that's in their class. This is the benchmark. And then this is where Guggenheim has performed, okay? So this is year to date. This is in the last 12 months. They had a 10% return. What a great return on a very conservative portfolio. And then over here is a 3 years. So you can see where it averages out. 3 years is 5.65% return, and the 5 years 5.45. Since its inception, 6.08. So really, I don't want to focus on these higher numbers because really this came from the opportunity that happened with COVID and the environment. But this is kind of like more indicative of what kind of returns you should expect, which is like in the 5 to 6% range. Right. So again, you're a conservative investor. You're looking to preserve your capital. You don't want to take on risk, but you want to have a decent return. This is a very good return for a low risk investment. So let's take a look at the next one. So Morningstar, they rated all the bond funds, and in their class for the last 5 years, they were ranked second out of everybody. Now, what's cool about this is out of 534 bond funds. Okay, they came in second place. Now, the thing about this too is that this only measures the performance of the return. It's not measuring that Sharpe ratio. So it's not really measuring the return based on risk. If it was based on the risk, then they would have obviously ranked number one. Now, this is a little bit, different historical data, but I do want to share this with you. So what this is this shows what your annual return is versus the benchmark, less the management fee. Okay, so if you were to, let's say, open up an investment account and we were managing that for you, this is what we charge is 1.95%. These numbers reflect this fee already taken out, so what they call net of fee. So going back to 2011, remember they started at the end of the year basically with 1 month left, so they had a return of 0.79 after paying the investment fee. In 2012, look at that, 12.92%. In 2013, 2.2, 2014, 8.25, 2015, 1.23, in 16, 620, 17, 649, 18.93, in 19.4, or rather 4.69. So you can see that this has some really good returns, and this is even after the fee has been taken out. So again, if you're looking for capital preservation, you want to have a good return, but you don't want to take on risk, this is a great portfolio for you. Again, these are the benchmarks in the dark blue, and you can see how they have performed against the benchmark. Every week, I have been talking about for the past several weeks different portfolio managers, and just kind of giving you a flavor or a sampling of that. And we're going to continue that next week. I'm going to have another money manager on, which is Tabor Kosmala, another huge, I guess you can say, institutional type money manager. They do some really good things. So we're gonna show you that next week. And again, every Monday, 6 o'clock Central Time, we're here. You can see the Zoom code there. So I want to welcome you and thank you for attending today's webinar. So if you have any questions, please give me a call or shoot me an email. I would love to meet with you. I would love to walk you through that 3D wealth system, and we can put a plan together specific for you to achieve your goals, your objectives, and bring that wealth to your family. So with that, thank you, everybody. Y'all have a good night. Oh, hold on. I got a couple of questions here. Let's see. S&P is doing good. Some are international funds with the COVID vaccine arriving. It's only a loss if you sell right. That is a great question. And again, the S&P, if you're going to invest in the S&P 500, you're definitely in a different risk class. You're not looking to preserve capital. You're willing to take on some risk to get some returns. And so we can definitely take a look at that. On an individual basis. Tune in next week, because we're gonna go over a little bit different risk class next week, and show you some good returns there as well. So to answer your question, you don't realize the loss until you actually sell or trade out of that stock. So having said that, I do get a lot of people asking me questions about specific companies, specific stocks. And it's funny because I usually get those questions from people that say that they're very conservative in nature. So what I recommend to folks like that is open up an account that, maybe put a small amount of money, maybe $10,000, and just play with it, and don't put the bulk of your money there. If you can play with that, you do some research, you like a particular stock or a particular ETF or a particular segment or sector of the market, and you really like that, you can play with it. If it grows, you can reinvest it. If you lose money, you're only losing that money that you set aside. But the bulk of your portfolio, I really say you should have that professionally managed to meet your risk tolerance, to meet your objectives. Again, the returns that we show you always net of your fee. So it's a really good way of doing it. I have portfolios, if you're interested in high risk, that are producing 64% returns. So if that's you, reach out to me. So with that, we'll say good night.